99% of tax lawyers teaching buy, borrow, die are fundamentally unqualified to teach the subject because they are inevitably crossing into capital allocation. They are moving away from IRS tax codes to something completely outside of their field. You know, I watched a few videos of other creators on YouTube teaching the buy, borrow, die. I genuinely thought I had competition. And after watching a few videos, I realised I have absolutely no competition because they fundamentally do not understand the financial physics behind the strategy. See, the strategy forces the investor to be a true capital allocator. There is no mathematical way to do the strategy as a passive investor. Unfortunately, a lot of people that watch these strategies think it is a cheat code. They think it is a hack. And there is no shortcut. You simply have to be a good investor. Now that terrifies people, but it should not terrify people because it is far more simpler than many people realise. And I'm going to break it down. See, the IRS is not your enemy. Capital gains tax is not your enemy. Capital gains tax is truly the cost of being right. And so many people are more focused on keeping their money from being paid to tax at the IRS that they forget the fundamental basics of capital allocation. You must outperform monetary inflation. And the tax lawyers do not understand this because they fundamentally do not understand the first principle framework of assets. If your tax lawyer or attorney or whoever, your CPA, cannot answer these three questions, you must fire them immediately. Question number one, what is inflation? If the response is, well, it's the cost of things going up, eggs, bread, milk, iPhones, things get more expensive because too much money is chasing too few goods. That's the textbook definition. What they're doing is they're tracking the cost of survival. If your goal is to survive, then track CPI. If your goal is to thrive, you track M2 money supply. When there's more money created, assets go up. This is the cost that capitalists track, not survivors, capitalists. And that's what we are on this channel. You see, CPI is truly a lagging indicator. Whereas if we go right to the source, M2 expansion, all the new dollars that are getting created every year, this is normally around 6 to 7% on average. You must be outperforming that hurdle rate, and then the entire strategy of buy, borrow, die makes sense. So let's look at it. You must ask them as well, why does a stock go up? If they cannot answer this question, they are not qualified to teach capital allocation. See, they might respond to something like, well, earnings. Yeah? You know, earnings is doing well, so therefore, the stock goes up. Or the CEO is very good. Or there's some good news. This is all wrong. This is noise. We're going to cut right through the noise and go right to the source of why does a stock even go up? Well, there's two main reasons. Reason number one, free cash flow per share or free cash flow goes up. The company's always creating more and more free cash flow every year. That is money that can be distributed back to you as a shareholder. Buybacks and dividends. Okay? That's the fundamental value for a shareholder. So if the free cash flow per share is going up year over year faster or greater than the money supply, that is a winning asset. Now, what terrifies a lot of people is they know the stats of only 4% of all stocks can actually outperform a treasury bill. This is true, and this is what people think it's like finding a needle in a haystack. It is not like finding a needle in a haystack, because the only companies that can truly outperform are the ones with true inelastic pricing power. This is the monopolies that have true power. So they're not hiding away. They're not hidden, they're open in plain sight. These are companies you probably already know very well. These are some of the biggest companies in the world. These are companies that are growing their earnings by 30% or 25 to 30% year over year. Free cash flow is going up aggressively because it's financial engineering. They can do this. Another reason the stocks go up, liquidity, excess money supply, causes multiple expansion. What does that even mean? Well, if the price to earnings is 20, suddenly it goes to 60 because everyone's buying the stock. That's it. More money in circulation, people buy the stock. The company's doing the same thing it did yesterday. It's just more people had money because the money supply goes up, so they buy the stock. But if we're buying at such a high valuation, eventually reality will pull it back down again. Yeah? So this is it. Why does an asset go up in value? This is another question for your tax lawyer. Why do assets even go up? Well, it's very simple. More dollars are created, the assets go up. If they'll say something like, well, supply and demand. That's not the true source. The true source is excess M2 supply coming into circulation, coming into the economy. What we want is the assets that grab that liquidity first. That's the companies with pricing power. They soak up the liquidity first because they can raise prices and they have that monopoly control. And what these tax lawyers will say is, when their commenters and their subscribers are asking, how do we service the loan? How do we even pay back the loan? What do we do with it? They're telling them to use their W-2 income. This is shocking advice. Terrible. That is not the answer. The answer is the asset always services the loan. Whatever the asset is, I don't care what it is, it will service the loan. That can be through the yield, or it can be through just the asset appreciation. If the company's growing 25% year over year and the money supply is 6%, it's outrunning the money supply. It's that simple. See, the IRS is not the enemy. Your enemy is M2 inflation. That's the true enemy. This is forcing you to be a good investor. And if people don't like the sound of that, then there's no easy way, there's no shortcuts to this. There's never been an easier time to be a good investor because the information is abundant. We focus on the financials, the intrinsic value. The greatest investors of all time have taught us how to do this. Buy, borrow, die is a mindset first, an investment strategy second. Of course, if I buy Google today, I don't know for definite Google's going to be around in 20 years. Of course I don't know that. That's not the point. Because the point is, the sell button is the enemy for most investors. Okay? If we eliminate that because it's part of our framework and our strategy, we've mentally tuned out of that sell button because we're doing this strategy, that can only benefit us. We only sell it if the asset truly loses pricing power. If the pricing power's gone, the moat is gone, then fine, we sell it. But if we don't have the mindset first, we'll just be like every other investor. We become traders. We become someone that's trying to time it and buy low and sell high. Then we've just fell back into the trap. That's why we have the mindset of the buy and never sell. It's a mindset first. It makes us better investors. The best investors hold for the long term. This is not a secret. So stop listening to these unqualified tax lawyers teaching capital allocation unless they can actually answer these questions correctly and they actually understand it. Because from what I've seen on YouTube is shocking advice on the buy, borrow, die framework. They teach it like it's a hack, like it's a shortcut, like it's a secret. They miss the fundamental point of it. It's more important to be a good investor first Because that will, if your returns are so vast and so strong, even paying the capital gains tax is better than someone being a passive investor who's borrowing against it, thinking they're doing some sort of secret. They're like, yeah, I'm borrowing against it like billionaires do, and their assets only returning 10%. It's all wrong. It's the same with real estate. Most real estate is painful truth is most real estate doesn't outperform the money supply, it merely matches it. Yeah? Only prime real estate in prime locations like Zone 1 London or prime Manhattan, the places that are very scarce really outperform inflation truly. More information coming on this. Leave a comment, like and subscribe.